Hey,
Howdy.
that's a pretty lit disclaimer intro right there. Obviously, we got to do that, because we got
Was we legit?
Mr. Breedwell has to stay in good grace. Is that an SEC thing?
Yeah, it's
Yeah.
compliance. It's a disclosure so you know that I'm a real deal financial
He's a
advisor. And if I say
real
things,
deal
I have
financial
to just,
man.
do them. It's a fiduciary.
Well, welcome back to the show, everybody. It's always fun doing these live streams now. We switched over to doing live streams on the Wednesday episode. I mean, it's Tuesday today, but we get this going on Wednesday. And obviously, the goal is to interact with more of you. So questions, comments, we want to hear it all. Man, it's I was hoping in the rear view mirror we would just see it get smaller and smaller and smaller, and the Iran narrative and the conflict was just slowly gonna dissolve into dust in the ether. But my little gut just told me that it was not gonna be that easy. And there's some conflict that kicked off again yesterday. Today, we'll break that down and how that's kind of tying into the markets. What is oil doing in response to that? Is the markets just shrugging this conflict off at this point? We got FOMC minutes tomorrow with Warsh. Warsh had some comments earlier this week that I think the market liked a little bit. We've got Amazon making some moves. We've got Claude crushing the S&P with its AI-powered stock picks and how they are getting in the game, bringing in kind of some interesting technology into, I guess, we'll call it the stock picking space. And I'm very curious to get your thoughts on it because while it all sounds great, will it sustain? Will it actually produce returns that people are looking for? And we got some crypto news because we do have some progress and some moves happening with the Clarity Act. Trump dropping some talks in his recent press conference around crypto and foreshadowing. We're going to see that kind of going. Man, can we start by just talking about how the U.S. went out? First off,
we did good. We did good.
I'm giving them their applause because I'm Team USA all day long. And honestly, the first handful of games were super fun to watch.
They were.
I was overly optimistic that they were going to go deep in the tourney after the first handful of games.
I don't think we were playing that great of teams.
Yeah, I think our bracket probably, quickly showed when we went up against Belgium. I was in my group chat with a couple of buddies and they were like, why do we look so shitty? And my buddy's like, because we're going up against an actually great team right now in Belgium. So that was disappointing. Pulisic, didn't do what everybody was hoping he was going to do. But overall, I think mission accomplished between
top
Mexico
16,
and Canada.
Right? Top 16?
Yeah, knockout round, top 16.
Yeah.
Between Canada, U.S., and Mexico as the kind of the host countries, everybody made it into the knockout rounds. The country was buzzing, man. When my daughters and my wife are sitting down, screaming at the TV with me and getting fired up and talking about shit that they have no idea what they're talking about. The US and FIFA just did a phenomenal job of getting so many people united, which is one of the things that I think I love about. I don't really care about soccer until World Cup rolls around. And then all of a sudden, when you really think about the people who work their entire careers and lives just because you only get, depending on your age, you maybe get one or two shots. If you're, maybe the rest, Messi or Ronaldo's, you get
Ronaldo 11.
Yeah, you get a couple, but to see people work their whole career and to represent their country, and then just to see the world unite behind their teams and everybody share in this competitive spirit, it's fun, man. I had a great time. So that was, disappointing to see them go out, but good run from the U.S. team. And before we dive into everything that's going on in the stock market, what's been going on with this new, kind of flare up of the Iran conflict, One of the things that we talked about in a previous show that I think is still, I'm extremely bullish on, is IRL trends, the industry,
They
sport,
are.
events, concerts. Like now more than ever, people just seem to be overly prioritizing the dopamine and the connection and the memories and the experiences that you can only get in real life events and experiences. Do you feel that same way too? Like, does it just feel like IRL hits different post COVID?
I don't really watch it. So
No,
like
but I'm
for
just
me, I
saying,
don't
like
really
in
get it.
general, right?
Yeah,
Like,
it's a bigger market now for sure.
well, I'm just saying IRL more so of like in-person experiences. People are spending way more. I mean, there's a lot of data that's coming out around how much money is being spent at, I mean, you look at how much people were spending on Knicks tickets, and the NBA playoffs had all-time revenue numbers. You looked at the World Cup. This is their largest World Cup, revenue numbers. You look at a lot of concerts and festivals, and people are really, I mean, shit, man. I would love for them to be investing in things that are going to generate them a return long term,
I hear you.
and yet you can see with where people are putting their money in experiences and where they're kind of prioritizing what they really value, like IRL, any companies, any brands. You talked about, AMC. We've talked about other, types of, brands and companies that are kind of benefiting from IRL trends and the industry as a whole. I mean, I'll pull this up real quick. This is a guy that I follow that's really interesting because he's talking about a lot of the dynamics of how social media, just social culture, pop culture, our societal culture is really shifting right now. And ultimately, how we see people kind of prioritizing and valuing things a little bit differently in today's world. Let me see if I can pull this up real fast, and let me know if you can hear and see this. So let me refresh this really fast.
I'll start off by saying something that might sound a little crazy, but I wholeheartedly believe that the next great global industry is going to be human connection. And you might be thinking, what the hell am I talking about? So let's break it down. We're continuing to see the same pattern emerge everywhere. Concerts are growing, movies and television, sports, niche experiences, events, conferences, festivals, experiences, and entertainment. People are spending more money than ever to be around other people. And at first glance, these all seem like completely different industries, right? And I get it, but they aren't, because they're all solving the exact same problem, right? Connection, belonging, community, shared experiences. Because for the last decade or so, we've seen the world optimizing for efficiency, right? Faster communication, commerce, transportation, entertainment, information, and technology has done an incredible job delivering all of that. Today, we can communicate with.
So, I mean, he goes on to talk about, of course, like we know that, the tech world and efficiency and just the digital age that we live in, it's not going anywhere. But I also think, as you always say, when the pendulum swings super far in one direction, we also see it swing back in certain areas just as heavy, or fast and furious. And it does feel like, because I know you and I, we love getting in person to epic experiences.
Yeah, I like to get into in-person stuff.
Right. And so I thought, with World Cup and what we saw in the NBA finals and what you're seeing with concerts and festivals and all this kind of stuff, I'm very bullish on in real life experiences. And I'm curious to see how this industry and this economy kind of evolves and grows. I don't know if there's any real big stocks that are worth, paying attention to in that particular
Live
space.
Nation, Spotify. I don't know if they're publicly traded. Live Nation for sure.
Yeah. So
I don't know if I honestly. I don't think we own that stock individually. I know we have exposure to it in fund, but Live Nation would be probably the one that immediately comes to mind if I was thinking of owning a stock in that arena, because their main gig is concerts and festivals. And then obviously from those two under the umbrella of the experience model, they obviously could have lots of verticals under that umbrella.
Yeah.
Like when
And I mean, I look
transition between one or the other, depending on who they needed to serve.
I look at the category kings, right? And obviously they're kind of positioned, if these trends continue to grow and expand long term, as being some of those category kings that already kind of, own the market share in those space, own many of the verticals like you talked about. I mean, even just we saw today, Netflix, Disney, and YouTube are all reportedly interested in bidding up to $2 billion for the U.S. rights to the 2030 and 2034 FIFA World Cups, based on all of the revenue, the eyes and ears, and the attention they saw people, one, behind their TV screens, and two, the people flying from all over the globe to come watch these sporting events. I mean, you look behind those, boards behind the players, and you see that they're the biggest brands in the world. They know that, these types of attractions are now more than ever getting eyes, ears, attention, and most importantly for them, dollars, flowing into those arenas. So pretty cool, pretty interesting, fun stuff. Well, let's talk about good old Iran U.S. conflict. Israel's kind of quieted down in this whole narrative, which I think is good, is interesting.
It's good. It's just, it's like one thing to the next, which just stinks. It just feels like I do the same thing. I was saying to you before the show, like, you can't do all we've done and then not continue to follow through. Yeah, exactly.
Well, so, I mean, they sparked
put yourself into that lane, right? Though, you know what I mean? You put yourself into that type of lane where, you went from here to here, and maybe here, would have got the job done, but you've already taken it here. You can't really go back.
Yeah, you can't.
So we've already gone to striking.
Mind you, it was Iran that kind of
they struck an oil tanker.
Yeah, they said U.S. violated, our MOU, being that we basically imposed sanctions again. We revoked Iran's newly issued general license to export oil after Iran struck 3 commercial vessels in the Strait of Hormuz yesterday. The U.S. called Iran's latest actions in the Strait wholly unacceptable and said they will be met with consequences. Some of our strongest strikes coming from U.S. officials. So, again, this conflict we were hoping was going to die down. I think it was last week, Kevin Warsh said that inflation risks have come down. And then I'm very curious to see how this new...
They didn't spike really anything. I mean, the 10-year went up a little bit. Oil's up 2% to $72 a barrel, but that's pre-conflict level. I mean, we were between 60-ish was our lowest, but we were around that range. And oil was trading around there around April 2024, May 2024. So again, not a huge deal. Do we want to see that $60 price again? Yes. Is that going to be hard? Yes. You just have the current regime there that they don't know how to. I think the problem is there's not really a leadership. So maybe the negotiating team is like, hey, chill. But then there's no one to enforce.
Yeah, I mean, they got a bunch of rogue, decentralized leadership factions that are all extremists.
Fighting for the power vacuum against each other.
Yeah, so whether or not they're all going to fall in line and not continue to create additional conflict going forward, I think is the bigger concern. But at the same time, like you said, I mean, we saw oil spike up to 76 and it ended the day down at 72. I mean, it seems like the market is still somewhat becoming more and more desensitized to this conflict.
I would say yes. If this would have happened 4 weeks ago, we would have seen a bigger down day than we did. But you saw the reaction midday, and then most of that was bought back up. The Dow, ended down 0.25%, NASDAQ 1.1, S&P down 45. The NASDAQ is just being enhanced because trying to kind of announce a little bit more of domestic favoritism to chip makers. So that's obviously going to pull. It's the semiconductor space in the NASDAQ that's hurting the most.
And that's really what we're seeing with this larger pull down.
Correct. And something you can do, like if you're in that little like box in the bottom right hand corner, kind of right, go up just a little bit more to the S&P. Go back to the home.
Yep.
Click this where the little bar. No. Go down. Yep. Down right here. Down to the right. There's those little 2 bars, and there's that box to the right of it. Click that. Is it working?
Yeah. Can you see it? Oh, it's
Frozen.
There we go. I had to show
Okay.
this.
If you scroll down on the right there, on that bottom right box where it says SPX.
Yep.
Keep going down. Keep going. See how the technicals are telling you that the market kind of is saying that it's in a buy zone right now? That typically is not something that you'll see when we're seeing enhanced volatility. It's probably slightly oversold, and the reaction is probably something that the market can take, is what it kind of looks like to me. So, and the thing that's nice about this is if you look at where we were in April to where we are now, I mean, we're still up. Go down to that right side again. See how that graph right there with the little blue line? We're up more than we were in 2025 at the same time. I don't know why anybody is complaining. So it just, a lot of times it's really easy to get disenfranchised by things in like a little window. But when you look at it, we're up 9.1% year to date. That's good for halfway through the year.
Yep.
That's not bad at all. So you can't get all worried about the little chop in the top right. That's just part of investing.
Yeah, that is. It's always good when you kind of zoom out and you take a look at the data, right? It kind of it cuts through a lot of the noise that we hear. I mean, I know from what I saw today, you can correct me if I'm wrong, but the equal weighted S&P 500 index has recorded 31 all-time highs so far this year, the second highest total since 2021. I mean,
that's equal weight, meaning there's a sector of the market that's probably not doing great, hence NASDAQ, and it's going to be semiconductors and chip makers. And it's all just because there's a lot of volatility in that space, with China having such a big penetration into the market as a large purchaser of those products because they're so technology dependent.
So we know that tomorrow, FOMC minutes.
Mm-hmm.
I saw this week we had data print, U.S. economy adds 57,000 jobs in June, which was well below expectations. I think it was supposed to be around like 114, 115.
Mm-hmm.
Unemployment rate fell to 4.2%, which is below expectations of 4.3%. May's job numbers were also revised down by 43,000 jobs. So based on this data of where we're seeing the conflict kind of reignite a little bit and how that's creating some volatility with oil and energy, which we know is going to be tied to what potential inflation we do or don't see on the CPI prints, which is what the Fed wants to, see coming in the right direction.
Yep.
We also know that the Fed likes to pay attention to the job and labor market. So based on what you're seeing and what these data prints are kind of foreshadowing for us, how do you think Warsh is digesting all of this information? How do you think this ties into the concern that people have around rate hikes this year, let alone just keeping it steady and seeing how the data flushes through the remainder of these 2 quarters to keep it more in a pause situation? What do you think the Fed and Warsh are talking about right now as they see this data come out and how they're going to digest it and really respond to it going forward? Oh, he had to lube the whistle up for this response.
I would say that think Warsh is going to keep setting the stage of how he is planning on translating that through without setting the Fed meetings up to be this breakneck fork in the road type meeting like it had been. But I still think he's going to be kind of middle line. He seemed a little bit dovish in his last comments, which was nice. And with inflation data not spiking so much, I think he's safe to still be dovish because the numbers where oil is at now, back when people were saying, the things that they were saying about inflation being, starting to run out of control again, and really it was just a spike in oil prices. We were sitting around $92 a barrel. When that oil price bakes itself in like it has been every day the market's open, that's going to hit into the CPI numbers. And I think what we'll see is a really sharp retracement, and that will bring more traders back into the market to start betting on a rate cut again. Now, the rate cut I don't think is going to happen. I think we're going to pause through the end of the year. But if I go to the Fed Watch tool and I pull the Fed futures for the meeting that's happening in about 3 weeks and a day, if it will load, there we go. When I go to the probabilities, right now we have 0% chance of a cut through June of 2027, with pause being the consensus for the July meeting. And then after that, the consensus being hiking. What I think is going to happen is when we get the CPI data in, it's going to rip that back to the middle and maybe put a potential rate cut back on the forecast, but I don't see it happening anymore this year, even though I said it was in July. I was hopeful, but we just didn't get the stars aligned like we needed to.
I mean, is this Iran conflict gonna, what in your mind could lead to a rate hike this year? Let's start. Nothing. You just don't see it. It's not.
No. Just as I'm being real that they won't cut, it's the same. They won't do either. They're going to pause throughout the whole year.
And why do you think that is?
There's no data to support.
The economy is just too strong.
There's too much volatility to cut, but the stock market and labor market are too strong to hike.
Yeah, it feels that way.
It just doesn't. You can't. There's completely contradicting items working against each other when they're supposed to be favoring and helping each other. And that's why, again, I've said that the way that we look at economic data seems to be so old and easy to update, but we don't. We choose to do it the way that we've always done it because it's the way we've always done it. That's the only good answer I can get.
Yeah. I mean, I am getting ready to, I'm looking, well, I'm working on a couple different projects, but, obviously as a real estate investor, I really want to see those cuts. I want to see the 10-year come down.
It's good for the stock market.
I mean, it's good for the economy as a whole.
They issue mortgage-backed MBSs, mortgage-backed securities. What do you need to have a mortgage-backed security, Matt? What's the first word?
A mortgage debt. And we need cheaper debt, right? So, I mean, I think people still need to be careful right now, but I thought this was an interesting little video right now because I think it's a good reminder that even if debt remains expensive, and this is obviously, we've been talking about this in all kinds of our previous shows, right? I mean, these are the seasons, just like in the stock market, you don't want to be buying green candles. I mean, you can, but the real alpha, the real edge, the real upside is captured way before the green candles actually happen, right? And that's usually when there's pullbacks. That's when the market is stale. That's when everybody, fear and greed index is, at an all-time high, or really fear is at an all-time high. And people are somewhat paralyzed, right? They're like, I don't feel comfortable putting my money into the market right now. And to your point, which you've always said, is those are the times that you got to put your money to work. Those are the times that you really have to. And of course, right, there's technicals and there's fundamentals. Just like in your world, there are things that you have to make sure that you're making a smart investment decision and you're mitigating risk and you're protecting your downsides and you've got a good game plan. In my world, you got a good team in place.
Mm-hmm.
But at the end of the day, like, these are the seasons when you can get life-changing real estate investment opportunities. I mean, these are the times that when debt is way more expensive and when, the market is stale and it's really hard to make deals pencil, when you actually can find an opportunity. And then all of a sudden in 12, 18, 24 months, you've got a good asset that, maybe wasn't a home run or it wasn't a triple. Maybe it was a double. Maybe it's a single, right? Like, singles get runners on base and they eventually over time put points up on the board. And real estate is a get rich slow scheme. It is not a get rich fast scheme. And as you know, in your world, right? I mean, it's long-term wealth building. We always talk about the crock pot versus the microwave. But it's hard for people to do that. Like, looking back in hindsight, I wish I would have bought way more real estate in 2010, 11, 12, 13. And the people who did, and the stuff that I did buy, ended up being some of my best investments when they tripled and quadrupled over the next decade. And I think this is going to be one of those seasons that we look back on in the real estate kind of market, that there will be some massive opportunities that when debt does come back in line, when the economics of your deal do make a lot more sense, if you own real estate and you can refinance it with cheaper debt and your cap rates are going to compress, and some of these levers that were really tough to pull before, now you have a little bit more flexibility to play with them, and demand shifts back over to the real estate market, you're going to find that you're positioned extremely well before the green candles of real estate start taking off. And that's really, Richard Baker, he's a, real estate billionaire. This was an interesting kind of, I think it falls in line with the narrative when I keep hearing people like, oh, there's no deals out there right now. Well, there's always a deal in every market. It's just more challenging to find them. You got to get more creative. You got to talk to more people. You got to, look at 5, 10, 15 times as many deals as you normally had to. But give a listen to, what he's sharing in this particular episode of the Iced Coffee Hour, because I think it's a reminder for anybody that's thinking about real estate. Now is the time to be still
everywhere. So I'm in the jewelry business. I'm out looking for that little jewel, and you can go anywhere. And some of the best jewels are in the most secondary, tertiary markets in the country because people aren't there paying attention. So the interest rates don't bother me. The general economy doesn't bother me. I'm out looking for opportunities.
Yeah, and he expanded on this a lot more in this episode. But to that point, I mean, one of the best deals I've ever found in my career is in a tertiary market. It's in, TJ Maxx, Harbor Freight. These are markets that normally they wouldn't have looked at, but now they're starting to look at these markets as well, because that they know that there's opportunities outside of just the bread and butter, down the fairway type of deals that they were afforded the luxury of doing and that were plentiful. Well, now you got to get a little bit more creative. You got to look outside of your box. So just a, reminder to anybody that's out there, like, now is a great time to be still doing real estate deals. Of course, be smart about it, be diligent about it. But don't fall victim to the narrative that most real estate investors are talking about, which is it's so hard and there's no deals out there, because there's always those opportunities. You just got to be that much more proactive and creative about it. This was another one that I thought was interesting. You and I we always have this debate on stocks and real estate, and we always agree that it should be both, right? Like, they both have their seasons and their time in the sun to shine. And oftentimes when one is, maybe in the shade, the other one is shining, and vice versa. This was another episode, kind of narrative around this particular, and this was, I don't know, do you follow Ken McElroy? He's a big real estate investor. He's got a couple $1 billion worth of real estate. Smart dude. This was his thoughts around, because Graham Stephan is he used to be a real estate guy. That was his whole brand. And then he decided that he was going to get out of all of his real estate, and he was only going to do stocks, index funds. Like he speaks, Mr. Breedwell's language and only your language now. And he always challenges real estate people because he knows the challenges of owning real estate, operating real estate, and oftentimes how unprofitable it can be for people based on the amount of time, energy, capital, and risk that goes into owning real estate assets. So I want you to give this a listen and give me your thoughts on Ken's response here on stocks or real estate.
Investing in the S&P 500.
It's interesting. Yeah, I've looked at that. The index funds.
Yeah.
I would say that's obviously one of the bigger ones, most notable. I looked at over 90 years, it's been 10%. 7, that's nominal though. 7% adjusted for inflation, I think. So if I'm cashing that out, I'm paying tax on it. And in real estate, I can make more than 7%. I can get my money out tax free. So I get the tax benefits from real estate. I get leverage, and I get inflation. If you want to learn more,
and of course he's got to put his little. If you want to learn more, hey, shout out to Gary. Thank you, brother, for the text. I appreciate that. What do you say to the real estate investors that that's his narrative versus I know there's a narrative on your side too that stocks is equally as powerful and a lot of the advantages that people say you can only get in real estate. You've educated me a lot on a lot of the advantages that you can only get in stocks or other strategies in stocks and investing. What say you to Ken McElroy?
I just think that a lot of people got to remember that leverage is just the shined up word for loan or debt. So whenever somebody uses that, it means that they're taking on debt. So you can, but then you're just renewing your contract to be a cash cow for a bank. Because the bank already got that money for less than you're getting it. And they're just lending it to you and charging you money. And you think you're smart because you're paying them interest back on their own money and not paying any taxes on it. I would argue that the fee that you pay back in interest is probably a lot more than the taxes over the amortization period. And I could almost probably in a correct scenario prove that. A lot of times the number one rule of tax planning, Ed Slott, very famous national CPA, his number one rule in tax planning is pay the damn taxes. A lot of times you over plan and you do so much to avoid taxes, you cause additional fees, you cause drag on return. You actually shoot yourself in the foot so much to avoid something that's really not that big of a deal. It's just part of being a human in the modern economies that we live in.
That's a really good point. One of my friends, shout out Pat Hyben, he always says, and he's a big real estate guy. Half the time he just goes, just pay your damn taxes. Like there's nothing wrong with paying
it's so weird. It's literally like people are like so avoidant to pay any taxes at all. And I'm like, you're dumb. I mean,
we as real estate investors, right?
Like, is good. It means you've made profit. You owe taxes on profit, not losses. And the thing that I would finish the sentence that the gentleman in the last video said. I don't disagree with any of the things he's highlighting, but just finish the sentences. I like to leverage, so I like to consistently increase my obligations in order to avoid paying taxes. Yeah. He's not paying somebody. He just doesn't want to pay the IRS or the FTB or whatever state entity might collect that. You're still paying somebody.
Yeah.
And by the way, you owe property taxes. You owe taxes on your rental income. You owe taxes when you purchase things for all these properties and sales tax. It's just you're not avoiding taxes by not paying income tax. I mean that or capital gains. That's just stupid. When you have a multi-million-dollar brokerage account and you have a brokerage account that's very large yourself, you get a tax bill for that, for the dividends and the gains you have every year. I don't think you're pissed about, oh yeah, I'm making money and damn, I have to pay some. That's part of the game.
Yeah.
It's how it works. It's people that don't really know a lot about what they're doing, just regurgitating what they think is correct. Which is what we deal with a lot in real estate,
I was going
special.
to say, I mean, in real estate, and I mean, I know I'll give a shout out to the strip mall guy. If you don't follow him on,
Yeah, I know the strip mall guy. He's a good dude.
he's great. He puts out a ton of, you know, consistent and great content. And one of the things that, you know, he runs a hedge fund. They only buy, you can guess it, strip malls. And I was kind of shocked because I've always been trained by a lot of the wealthy real estate investors I know is, you know, defer taxes and kick the can down the road and swap till you drop and 1031 exchange till you die, right? I had 2 failed 1031 exchanges last year, and, you know, I cut multiple 6-figure check to the IRS, and that hurt. But I was also sitting now on a nice chunk of liquidity that I could roll into other things. I can now touch it versus it being locked up. And so to your point, like, that was probably one of my first experiences where I'd sold, you know, some larger properties and had a really hefty tax bill that, like, really, really hurt. And to your point, one of my, you know, mentors was like, dude, you're paying taxes, you're making money. Now, don't get me wrong, you don't need to overpay. You can find different strategies and ways that you can minimize that. But at the end of the day, don't be afraid to sell shit just because you don't want to pay taxes. There's
Yep.
an opportunity cost in this fallacy that if I pay taxes, I'm taking this major step back. But there's also so much opportunity that can be gained out of creating liquidity and peace of mind and building up reserves, expanding into diversification versus it all being consolidated into one.
Lowered your DTI as well. Your balance sheet got balanced.
Yeah.
Just don't get, again, it's a fallacy of a lot of real estate investors to over believe in what they can do or what real estate can do and completely ignore stocks. A lot of times that's what they do.
I did until I met you, you know, a decade ago. And now I'm
educate people.
especially this last, you know, few years when real estate has been more challenging. I'm like, thank God I look at my Charles Schwab account and see Mr. Breedwell, you know, making me some nice gains by having that diversification of investment outside.
Have it all.
I was like, oh, I'm just a real estate guy. I'll never invest. Well, now
you can be heavy one way or the other. I'm not, you know, at some point you're not going to be right down the middle, right?
Yep.
But you can have both, and you could be serious about both. If you made your money in stocks, hey, go take some of that. When you're, we have a mutual connection that's retiring here in a month, and I'm going to fly out to see him. He has a pretty decent public name, so I'll forego saying his name, but you know who I'm talking about. And he literally got his real estate license because we're sitting here scratching our heads like, Buck, you're going to get these huge deferred salary. They're going to pay him out this huge fund over just a couple year period. It's great, but it's going to add like $1 million of income to his income every year that he doesn't need. So we're like, bing, you're retiring from your career. You already own a couple real estate properties. Get your license and open an LLC. And now you're managing your own property. It's legitimized. You're actually dedicating all your time to that. You will meet the IRS. I forget the test they do, but you'll meet the hourly test and you'll be able to get the benefits of it. He ran it through a tax firm. They double checked it. Ding. Yep, that'll work.
Yep.
So completely made his money in stocks and his job. That's what he's done. We are now using some of that money, a couple $100,000 of it that was supposed to go to me. I said, why would we not push it over there? And then, like, I think the plan is in sell it in 4 or 5 years, then put it back over to this side.
Yep.
Why? Because we avoid the taxes now. We capture the upside, what we're trying to get then. And then when we sell, we'll pay capital gains again. But the math works out to swing in his favor by a couple $100,000.
I think when I hear that too, it reminds me you have to be willing to pivot and adapt your strategy based on what your goals are. You know,
yeah, to a degree. You want to make sure you don't stop doing what you're doing to do something else. You can do things that enhance the other thing. So another thing you don't want to do is like, hey, everything's working. Let me go try to find the next best thing because I have a feeling that there's some sort of next best thing that exists when everything's already working. Especially when I don't have experience or very much experience doing the next best thing. It's hard to convince somebody sometimes to get out of their own way, but I can see it from 1,000 miles away when I have somebody that's getting into that mindset, and I'm like, this is it. You don't have there's no more dragon to chase. I mean, it really is.
That's
It's
hard for people though, right? Like,
yeah.
especially entrepreneurs. And when you're playing the wealth game, people want to try and keep climbing the wealth ladder rungs.
Yeah, well, you miss a rung eventually and you fall all the way to the bottom.
And you slip 5 or 6.
I've seen it happen.
Yeah. So okay, so
all the time.
Talk to that real quick, because I am very interested to hear your perspective, being that you've been intimate and in close proximity to that with certain people. Like, why do people do that, and how do you think people can avoid that while still playing the game of wealth building? Because it's hard, right? Especially in this world now where you got fucking 500 people in your feed every day making crazy amounts of money, and this new thing is sexy here, and oh, by the click of a button you can do X, Y, and Z and get this, spit out on the other end in seconds. Like, how do people avoid that trap while still playing the game smart and intelligent?
I think that taking a step back and asking yourself, like, what's really going to make you happy? And it's like, we're talking about like a retiree. Do I really need to take on this type of risk with my life savings at this point in my life, when my time horizon doesn't lend me the ability to make something back that a 30-year-old, might have the stomach for that type of risk, or a 40-year-old might have the stomach for that type of risk. But is it really a good idea because of what could be, even though I already have things that are already working and doing what I need them to do?
Yeah.
To me, it's just like, that's a bleed out of other areas in your life. You obviously have issues in other areas of your life because you're never satisfied. When something's working, it's working. When I have a good meal and tastes good, I'm happy. When I have a successful business venture, I'm happy. I'm not sitting there scrutinizing it, asking how could it been. It's good, but could it have been better? And what if?
I've seen so many
bottomless pit of life to live in.
Yeah, I've seen so many people that have fuck off ton of money and they're really unhappy. And it's an interesting dynamic, especially when you're in this world of entrepreneurship, or if you're in mastermind groups, or you're around wealthy people, and like you're like kind of the natural dynamic of we as humans want to compete, especially entrepreneurs, right? And one way that a lot of society creates status and importance, and a lot of people wrap their identity up in their balance sheet, or how much money or commas and zeros they see when they open up their fucking app, right? Or their brokerage account. It's hard for people not to get wrapped up in that. I mean, I'm guilty of it. I think a lot of us get guilty of it, in the sense of, you want to play the game, you want to compete, you want to, you can get sucked into that vortex, but it is a lifeless, never satisfying path to nothing if you cannot find a way to be happy on a daily basis with what you have and what you've built and who you are. Like, it's cliche as shit, but at the end of the day, especially in today's world, I wish, because there's a lot of people that I know that have a lot of money and they're egotistical and arrogant as fuck, and I'm like, dude, you've figured out the game of business and wealth building and investing, but that's just one vertical of a pillar in the overall infrastructure that I think makes a good human being. somebody that's happy, healthy, fulfilled, great with their kids, great with their, you know, their partner and their spouse, right? Like that is giving to other people, to other charities, other causes. Like that's just only one component of it. And so you can't fall victim to wrapping your overall happiness and identity up into winning the game of money only. Now, don't get me wrong. We play it because we love it. And there is that ego that you got to feed it at some point, right? It's like the wolf, which one do you feed kind of thing. I think you have to feed all of those equally, know that there's dangers that come with all of them if they swing one end or, you know, another too far. But I do think it's interesting to kind of just keep that as a topic of awareness, knowing that we are playing this game. I do measure success based on seeing the account go up versus it going down. But at the end of the day, that doesn't make me a better person. It just kind of gives me more of an opportunity to showcase like who I really am at the end of the day. And that starts with me doing the work on myself and just being comfortable with who I am.
Yeah, my day normally starts with I've been, you know, I go find myself. I've been, you know, I've traveled a lot and drinking a lot of coffee from different places, and I've really become a fan of Scandinavian roasted coffee.
You got me into the coffee game on another level.
I just got a new espresso machine, like a real deal one. So I like to find the grind setting of my beans, find the weight of grind out, find the weight of water out. So I dial that in. I take that little shot, make my little espresso, and I go and sit on my front porch because the sun rises right there, and I just chill. I don't have my phone.
Simple things
on. I just sip and listen, and I'm very happy that I know somebody rushed to Starbucks, got themselves a mass-produced drip coffee or a sugar-filled something, didn't get to have the intimacy with their morning like I did. Their wife's not asleep, doesn't have to rush to work. Their kid's not asleep, being an awesome kid. And they've already off to a rough start of the day. I'm sitting on my porch in my Pokemon shirt with my sweat shorts on and my flip-flops, and I'm sipping my Americano, and I'm about to go start my day. So when you can have
gratitude in the simple things,
success in my business, I have plenty of it, and you know, I'm lucky that keeps coming. But you have to be able to grasp onto the little things, and I think that's an indicator to me that I also am, you know, I've grasped onto the big things in my business, and I'm well aware that I'm being successful there. But recognizing to take time out, going about in the middle of my day for about 2 hours today, and I just wanted to go watch the World Cup. I'm not a huge soccer. I just need to get out and have a little bit of me time. Having that ability, that's real wealth to me. Yeah. Being able to go out after this, and I'm going to go cook with my wife and son and have dinner and spend time with them. That's wealth to me. Being able to afford to have help so my wife can have a social life and a work life and a mom life. That's real wealth to me. So that's when you recognize it. It's not necessarily just how much in net worth you have or how much in debt you can raise or what your portfolio. It's, you know, what comes after that.
Yeah, no, I think it's good perspective, right? I mean, I want that for everybody. And mind you don't need to have a lot of money to find beauty and happiness in the simple things either, right?
A lot of times, but it's not a requirement.
All right. Well, we're talking about the simple things. They're talking about when Ben Malla, who I don't know if you follow Ben Malla, but he's a beast, and he has built a massive real estate empire. When I owned all my hotels, I was really into following him, and he's a big personality, but he keeps it real. He talks his shit. He backs it up. But he also does right by people. And so I respect people like that. He's got a little Ryan Breedwell in him. And they were asking him around this idea of like, when did he feel wealthy? And I'll pose this kind of same question to you. If it's more of a number thing or if it's a feeling thing. This was his answer.
100 million? It was what it took to feel wealthy.
To feel like I didn't have to worry about anything major happening. You gotta understand, I may have had 100 million, but I probably owed 200, 300 million. You know, when you start becoming equal with the bank, then you're pretty good. And when you start becoming worth more than what your loans are, then you're even better. But borrowing money is a way to save taxes. Because the more you borrow, the less you make, the less taxes you pay.
So this kind of ties into what we were talking about earlier.
You just got to keep leveraging and leveraging.
And it talks about kind of the magic dragon, right? Chasing that magic dragon of like, you kind of gotta keep that ball rolling.
Eventually, there is a
you don't want to
point.
be holding that kind of debt when the shoe drops.
Well, not even that.
Leverage.
Like, where what asset class do you eventually go? I mean, you're going to get to a point where you have to you have to buy either portfolios of large assets or like big, tall buildings in metropolitan areas that are hundreds of hotels of hundreds and hundreds of rooms. So just, to me, it's like, I don't want that level of liability. I would like to, if I had $100 million in stock, I'd like it to where my net worth is like 100 million. Your net worth is not 100 million if you have $100 million in equity, but 300 or $200 million in debt, your net worth is negative 100 million.
Yep.
So to me, I just prefer, I know it's faster to leverage. I get it, but there's a point where an equivalent value of portfolio, I don't care about the tax benefits because eventually it doesn't matter because you're making so much more money. It's like, do you want to not pay taxes? Do you want to make twice the amount of money? It's like, I make twice the amount of money.
Yeah.
So they both have their merit. I just think that to me, I don't want to have 300 million in debt in order to get $100 million in net worth. To me, that just doesn't make a lot of sense.
And what does make sense to you? Because I love your perspective on it. Because me, I'm like, I'll take 200 million in debt to have.
I don't want to service that debt. It's not quantifiable to service $200 million with $100 million of cash.
Fair enough.
It's just not.
Yeah.
Do the math. So all you're reliant on is other people doing the right thing at that level. A lot of other people doing the right thing. And then all those people's lives who don't revolve around yours, so they're probably having tenants at this point, all their problems and how they become slightly yours, all their, late payer. I don't want any of that, man.
You don't want to fuck with it. He says, no, he's out. You're going to stay on
portfolio. Just, you can get about $5 to $7 million a year with like zero stress, like $500,000 a month of just right to the bank account and just nothing less than 0.5% in total overall fees.
That does sound.
It just doesn't exist.
Yeah, really. And this is why the more I invest in stocks with you, I
would be an asshole to not say it's easier to get 100 million in real estate than it is stocks.
Yep, agreed.
You have to then take that a step further and like remove the asset class. What are good things easy in life? No. Are typically better things sometimes harder to get?
Ding.
So that's me. I just am like, I would take $100 million in stocks over $300 million in real estate. 100 times out of 100.
I would, as a real estate,
it would take. You want to know how long it would take me to get to 300 million with $100 million? Less than 15 years.
In stocks
with zero effort.
Yeah.
Literally buy an ETF. I would have to do nothing. So I'm just telling you. 100 times out of 100, I would take $100 million. I wouldn't give a fuck what people said about, oh, you should have taken the 300 million. You could take. I don't care. I'll take a $100 million net worth to a negative $100 million net worth all day. Well, really 200 million all day, every day. There's no doubt.
Yeah, I mean, owning paper assets and businesses.
You ain't making $500,000 a month with $300 million in real estate.
No, you can't. Your
operating costs are through the roof.
There's just so many moving pieces. To your point, there's so much that could go wrong. There's so much physical labor and stress that goes into it.
Your investment account, there might be volatility.
Yeah.
And in fact, I'm not even going to say there will be. We actually don't. We just don't know when it'll happen, but it will happen. But we already know the formula to fix it. Don't do a damn thing.
Just
and then
ride that baby out. All right. So this was something that I thought was cool. Mr. Banks, you know, is a young fella.
14 months as of yesterday.
My youngest daughter, Amelia, just turned 2. Anybody with young kids that's listening to this right now, if you have not taken advantage of this, I thought this was cool. The Robinhood CEO reveals that 6 million kids signed up for Trump accounts before launch.
I did too.
And the Trump accounts are not just an extremely cool, nice to have, but potentially the answer to the boomers' social security that maybe run. Is Social Security going to run dry first off for our kids? You don't think so? They'll just keep kind of.
It won't run dry. I can't say those words, but I can say it could potentially look a lot different for you and I than it does for current retirees. But I don't know if it will.
So check this out.
I'm not worried about it. I'll tell you this right now. I have zero. I don't even work Social Security into my retirement.
Yeah, I don't either. But a lot of people do. So obviously, you know, something that people are still paying attention to. But if you got young kids, I mean, and you look at this, estimates are for illustration only and are based on the account opening at birth with a $1,000 opening deposit and are derived from historical S&P 500 averages.
What the
Check this out. So you can go on their website and it'll kind of show, but at age 18, 27, this example is at 55. If you contributed nothing, by the time they were 55, that $1,000 based on S&P 500 averages would turn into $243,000. If you can,
I need to get their illustration software. My God, where are these numbers coming from?
Is this not accurate?
Those look pretty high.
Okay.
I don't think that you would have 200
over 55
The one
years.
on the far right is really what's tickling me because I'm like $5,000 a year.
$5,000 a year based on S&P 500 averages compounding over 55 years. That does sound a little high, right?
That's $275,000 turning into 13 million. I mean, hey,
you're
advertise for advertise.
I saw this, so yeah, we'll fact check this, chat. Everybody fact check it. But if Chamath posted this. If you can choose where to work somewhere that will help invest in your Trump account.
Oh, hey, I don't fuck with this guy too much, but we're gonna get hats off moment. He said the R word.
He said, sorry, but that's a huge amount of money. If you have this choice but don't want to because of TDS or because it's called Trump, of course Trump would find a way to put his name on it. He's doing it everything. But in general, I think this is just a good reminder for anybody that hasn't taken advantage of the Trump accounts.
Please do.
For your
even
kids.
If you're a liberal. Take his money.
Free money.
Come on.
Get your account set up for your kids. And this is something that could be fun that they can follow along with and they can watch grow. This is like such a good thing that the Trump administration did. Michael Dell did. I saw Dell pump this week because Trump talked about getting
Micron also committed a bunch of money to it. What it is doing is it's allowing U.S. corporations to finally invest in people directly,
which is awesome. I
think like this. Hey, we bought this program, so you go to it, and then you get to call it. Here's cash.
I just thought that was
it's just
really cool. I think that any kind of opportunity that the government gives its citizens the ability to, one, have some ownership in something, and two, the lessons and the opportunities to learn and to be a part of it, right? To be in the game. What better way to get your kids started now? So I thought that was pretty cool. Last one that we can kind of wrap up on was, I don't know if you've been paying attention to Elon Musk, X Money.
I did see the X Money launched.
All right. Yeah. So let's, we'll kind of close it out on this one. X Money is Elon Musk's financial platform, which is inside of obviously the X app, combining an aggressive digital wallet and a high-end debit card. So here are the key takeaways from what they just launched. You got 6% APY. That is juicy. I like that. Offers a market-leading cash yield, beating standard high-yield savings. They're going to give you 3% cash back on every dollar spent, unlimited cash back. They give you some cool metal Visa card, up to 10 million FDIC. So it protects standard accounts up to 250,000 or 10 million for premium users. And it supports instant P2P transfers to X handles. So just think of like Venmo inside of anybody wanting to use X Money on the X platform.
I don't see it on the app. I'm like looking on the app. I don't see it anywhere.
I don't think they've officially like launched it. I think it's coming out later this month, but they did note, and let me see if I can see when it's coming out. But let's see here. When are they launching this? I think it's coming out later this month. And there's also free wires, bill payments, checks, and free ATM withdrawals. So how they're going to be able to sustain that level of APY, I don't know.
Ad revenue.
But I do know that
that's how they're
going. I don't bet against Elon. And I do know that this may be, like you said, this may be one of those where they're not looking to clip some crazy margin. This might be a loss leader for getting more eyes, more money, more, and it's probably not going to be a loss leader. I'm sure he's going to be making money off it, but they're smart, right? Like a lot of people know now what the banks are doing, and the fact that they're paying you less than a point and they're lending your money out and they're turning it over multiple times and they're arbitraging this spread and they're making out, no pun intended, to the bank laughing the entire way. This is Elon saying like, hey, we can share in some of this with you. We're still going to do what the banks are doing, but because of the spreads we're making and the margins that we have, we'll give you 6%, no problem. Mm-hmm. And I think that's a great way. These are the things that spenders and people are starting to become more educated on. And I know Apple talked about doing this for some time, and they didn't really
have it. I have Apple Cash and the credit card.
Okay.
I like it because I don't use Venmo at all.
Yeah.
Or Cash App. I only have Apple Cash.
Well, there you go. So something cool there. Closing out on crypto. The market may have bottomed. We still see the 60,000 baseline kind of holding for Bitcoin. I think it's where is it? 64 today. We did see that Strategy again cut their Bitcoin holdings by 3,588 Bitcoin. Saylor sold 250 million worth of Bitcoin at 60K. Kind of funny. He buys the pumps and he sells the dumps, which is kind of interesting. I think this is really the first time people are starting to really question, like, what is he doing? Why is he doing it? Is Bitcoin really losing its steam and its allure that so many people have been giving it, its merit for some time? But the two crushing narratives for Bitcoin were stocks going down and Saylor selling. Both of those are, were somewhat happening at the same time. So I don't know, but I also saw that Trump did mention the White House says the U.S. government is working to structure its strategic Bitcoin reserve and crypto stockpile. Trump calls himself the crypto investor. Did you see that he reported more than 21,000 trades across 8 investment accounts in 2025, averaging 80 trades per day?
Baller.
Dude is investing heavy while he's sitting in the White House. We'll just say that.
Well, there's no regulation on it right now, so he's not breaking any rules.
I mean, he's not breaking any rules, but he ain't setting any precedents on what he does or doesn't want to see going forward either. I
think that what he's saying is he's the crypto president. He's letting people know he uses it. I don't mind it. I got no problem with it.
let's see.
WLFI, I think is World Liberty Financial. Oh yeah.
Yeah, that's his kind of opportunity.
I buy it every week.
Trump's financial disclosure hit the Office of Government Ethics on June 30th, 1.4 billion in crypto earnings in a single year. Your sitting president of the United States, he is the single biggest crypto earner in the country and is now signing the legislation that governs the asset class that he's doing mighty fine profiting from. But we're still hoping to see Crypto Clarity Act come into play. So I do think that we're still going to see another little dip here. I don't know, though. This might be the bottom. Maybe it is. Maybe this whole, Crypto Clarity Act, where we're at in this market cycle could be different this go around with just, you've always said it, right? Like just because it was this in the past doesn't mean it's going to be the same repeated trends and cycle every time. And sometimes, things are different. So what do you think? Bottom, or you still think we got a little pullback coming to really find that last bottom and then, see another run?
I think there's more volatility for certain names and there's less for some in the future. And the magical thing about time is it'll write the story for us and tell us.
Yep. 100%. Let's see. Last thing that I got on here is 4 months ago, Claude set up with a brand new $50,000 portfolio to see how well it would pick stocks. And Claude is up 14%, while the S&P is up 10% in that same period. It had a bunch of kind of random no-namers. I can pull it up on the screen for you to see what. Let me pull this up so we can see what Claude was picking. I mean, basically I see more crypto people. I see more stock traders are all starting to, leverage bots and AI agents. And I don't know. I just don't see how but maybe it is. Maybe it is going to work. What do you think? I mean, right now, Claude's up 14%, while S&P is up 10% in that same period. These were AI was the biggest theme in what it was, picking. Financials, I think the market has mispriced. So there were some of these names. I don't recognize any of them. You would know more than I would. Healthcare, though, these are all sectors. And this is all based on Claude code, managing a portfolio. And are we going to see more of this? Are we going to see more people shifting to this? Is this a threat to people in your industry at all? Like, what do you see?
So. I think that some people will choose to use robo-advisors backed by AI, which have been around for a long time already. There's still things that humans do that tend to beat those models because lines of code are still just lines of code. They can kind of crunch data fast, but they can't see the intricacies, kind of read between the lines. So I'm not worried about it. We use it and we leverage it to help us, but I think that's really what it will do. It'll just be leveraged more by human traders.
I think that's a good point. I said this to somebody the other day. AI is not going anywhere. The people who think it truly is a threat to their jobs, I think are looking at it the wrong way. I think you need to look at how it can enhance your job and actually build a moat around your role, because there's always going to need to be some level of a human element tied to many of these roles. And look at it like, a bolt on to your tool belt, and it's an extremely robust advantage and edge that you can gain by embracing it, knowing it, figuring out exactly how it applies to your role, your processes, the outcome that you're trying to drive towards, and master how that applies specifically to you, right? Mm-hmm. And I know you're kind of that way. You're like, I'm not going to fight it. I mean, it's not going to be dominant in everything I do, but I know that there are going to be elements of it that can make you sharper, more efficient, more effective. And anybody that I was talking to my attorneys, like anytime I interview an attorney now, I'm like, are you AI friendly? Like, I'm not saying I want you to be AI first, but I also want you to be effectively and efficiently using this tool, because it can save me money. It can make you better. It can make all of us more, efficient in what we're trying to do here together. And there's a lot of roles in the world that should be thinking about AI in that same fashion, right? Not fighting it, but also not, giving it its flowers and saying, I'm going to hand the keys to the kingdom to you and just sit back and do nothing. So I just thought that was interesting. I figured I'd throw that over at you. As always, we're going to wrap up on that today, guys. Appreciate you guys. If you were live, you were tuning in, saying what up to us, drop us a line in the chat, say hello. You can always drop comments on YouTube, Spotify, all the, the spots that this video is streaming on. And don't be afraid to, pepper us with some questions live on the show going forward. We always love your thoughts. If there's any particular things that you're looking at, that you're paying attention to, that you're interested in, I want some of that alpha too. And I know we got a lot of smart people that are listening and watching this show. So as always, we appreciate you guys. If you want to connect with Ryan and his amazing team on your investment portfolio, stocks, building out a long-term plan, comparing it to what you have now, what your fees are now versus I think that's always the biggest thing that we see is people are getting way overcharged. You can text the word XRAY to 844-447-1555, popping up on the screen there. That'll connect you directly with Ryan. And if you're a passive investor and you are looking to get some exposure to some private lending, hard money, basically being the bank with us, the Imagos Income Fund we got some great listeners that have been invested with us, many other investors around the country that are looking for that mailbox money to generate some additional passive income by being attached in first position to collateralized assets. Of course, you guys know what my bread and butter is, real estate. So you can text the word income to 844-447-1555. Until next episode, thank you guys for tuning in. We'll see y'all later. Peace.
Cheers.